slump down about 15% from here.
Correct.
Which then recovers by year end.
Mostly recovers, correct.
All right.
And I think you want to think about it a couple of ways. The first is what prompts this, and that's a earnings recession. And the challenge here is that data and the information, the news flow has been so volatile and so difficult to understand. And so we've made some assumptions in our model. We've taken down our earnings forecast for 2020 to $157.
You cut to 165
exactly.
The other day.
A little bit like Groundhog Day. So it was about 2 weeks ago. We basically took a number from 174 to 165. Now it's down to 157. So a year-over-year basis, as portfolio manager thinks about it, it's around 5% decline. So that's sort of the story. But a famous trader at Goldman Sachs used to remind me, Teddy Wang, he used to say, David, the path matters as much as the target. And so when we think about the path of what's happening in earnings, for the second quarter, we're likely to see earnings decline by about 15% year over year. The analyst community is looking for up 3%. And for the third quarter, we're looking at year-over-year growth of down 12%, and the analyst community is looking up 8%. So that it tells us that there's a wave, in our view, of negative earnings revisions that are likely over the next 3 to 6 months. And that's something to be thinking about. And it's rare that the market moves higher when analysts are cutting estimates. Although at the last cut, typically, you see the market rally. So that's the narrative of why we get to around 2,450 around mid-year.
How do you, viewers might wonder, all right, how does David get Q2 earnings down 15 when guidance is non-existent?
Correct. And so guidance is non-existent, and we acknowledge the fact that management's, the news flow is coming in every day, and airlines are having their challenges, and there's quarantines in different areas, businesses, people are working from home. So all these things are happening, but that doesn't mean that the market isn't trading. And so we need to have some level of guidance or some level of estimates, a way of thinking about this. And so what we've done on assumptions, recognizing their assumptions, if the annual growth is down around 5%, how does that get distributed across the course of the year? And so you have negative growth in the second and the third quarter, particularly prominent. That'll lead to negative revisions. Fourth quarter is probably going to get better, and now also growth in 2021. And that's the experience of some of the prior episodes that we've seen. Market goes down sharply and then recovers at some point next year.
Why do you think you're so much more pessimistic than other analysts and where the market is already? Well,
the market has clearly come down a lot. It's down 15% from the high.
But you see more pain.
And there's likely to be more downside to the market in the next month, or next couple of months until basically third quarter, where that negative earnings revisions are likely to be most concentrated. So why is it? Well, if we take some negative assumptions, we have energy prices that are down. We have, which is obviously affecting energy earnings. We have lower bond yields all across the yield curve. That's a pressure on the net interest margin for banks. We have lower earnings in the bank sector. You have negative, the consumer is also pulling back. We have a number of technology companies which have withdrawn or guided down negative companies, negative guidance from some of the semiconductor companies, some of the hardware companies with withdrawing guidance. So those are the drivers of why we have overall profits coming down. And so the question is, well, how is that going to be distributed across the course of the year? And our estimation is going to be most concentrated in the second and the third quarter. But later in the year, as the market is looking forward, investors look forward into the 2021, likely to get a positive earnings growth in the next year. Now, way to think about this is what has happened in prior event-driven bear markets. Okay, event-driven bear markets, like 1987 crash. You can look at 1998. What happens? Market goes down 20, 25%, 30%. And then in the next 6 months, it typically rallies back 20 to 25%. You get median recovery is around 22%. And so the path that we are anticipating is pretty consistent with what's happened in history. You still have a bear market, and then what's the recovery, or what's the trend after that?
It's just hard to predict the timing, I would think, without knowing the trajectory of the virus in this country. How many people get it, and what it looks like?
There's no question about it. But if you are dealing with a portfolio manager, if you are running money, if you are a portfolio manager, whether it's a hedge fund, whether you're a mutual fund, you have to make some assumptions. So we're offering some roadmap to how to think about that. And that's, I think, it's the challenge of every fund manager. So then what do you do as a fund manager? Well, obviously, the market's going down. It's a little hard to navigate that. But some of the real estate companies, which have more contractual revenues, and we have a dividend yield, so that's a way of thinking about it. The higher quality, use the word higher quality, but a more stable, growing companies, which you look at the EBITDA, the variability in EBITDA over the past decade. So if their companies have had pretty stable, those companies trade around 20 times earnings, 15 times the rest of the market. So you're paying a premium for that. So you recognize that that's one of the challenge in the market.
I mean, recessions do create their own dynamic, and there are oftentimes things that we perhaps were not that much aware of in the financial system that can raise their head when there is stress. That's just an unknown.
So one of the drivers, we talked about earnings and valuation. So what about positioning? What about sentiment? What are we seeing in terms of the client information? Well, at the peak, which was just a couple of weeks ago on February the 19th, you had the positioning of our clients, institutional clients, retail, pension community, were 1.7 standard deviations above the average. Okay, so they were pretty long, very long. Now they're 0.8 of a standard deviation, so not quite a standard deviation below the average. But the idea of what happens in bear markets is they usually get 2 to 2.5 standard deviations down. So we're about halfway there. As one of the traders characterized it to me at Goldman, you basically going from 9 out of 10 long. We're maybe 5 out of 10 in terms of de-risking. And that would suggest there's still more to go. So if you want to think about it from a money flow point of view, there's fundamentals and there's money flow and positioning. And liquidity has certainly come down as well. And so those are some of the concerns we have.
Let's take a couple hypotheticals. There's news now that the House Dems are going to introduce a bill today on sick leave, unemployment insurance, food stamps. They aim for a vote tomorrow. If stimulus response in this country is more aggressive than we think, if the Russians and the Saudis say, let's put our differences aside, aren't you being too bearish?
So we'll think about it from an S&P 500 perspective, put that in that context. Energy prices, when they came down almost $30, they were 66, now they're mid-30s. That's worth about $3 a share, $2 to $3 a share in overall S&P earnings. So it's a relatively small part of the overall picture. What's much more important, if you will, is technology. What's the technology? There's about almost 25% of earnings come from tech. The consumer, what's the consumer doing? So yes, if you have some fiscal stimulus, that could be certainly a positive as opposed to a negative, and that would tell you that maybe things wouldn't be so dire. But our view of a 5% decline in earnings between 2019 and 2020 is not that dramatic.
How does that compare to previous periods? I mean, I would assume trying to figure out the depth of the decline here. I mean, you reduced your numbers twice in the last week?
Right. So earnings
is very difficult.
So earnings typically fall by 13%. You go back to every recessionary
event-driven.
No, look at any recessions.
Oh.
You characterize a recession.
Right.
You look at all the recessions back to 1947. So for 75 years, what has the experience been? The median experience is that earnings fall by about 13%. In 2008, it was much more dramatic. Banks in particular, right? There was 2001, technology came down. So there's a variety of episodes, but the long-term average is around 13%. And so we're looking for a less dramatic decline because it's a unique type of economic disruption, as we would say, right? So, and then there's also a less robust recovery in earnings. So we have about 11% growth from next year. So they come down and then they come back up. So it's a shallower decline and a sort of a shallow recovery. But broadly speaking,
we kind of end up back where we were.
You pretty much end up back where we were.
But do we end up with the same multiples?
Well, the other thing we haven't talked about is bond yields. What have bond yields done? They started at 190 at the start of the year. They were 1% about a week ago, and they got dropped to like 30 basis points earlier in the week, and now they're kind of 75, 70 basis points. And so that's affected the
what about the credit
valuation.
market, David? I mean, do you see indications of stress there that would trigger defaults, downgrades?
So you can look at the broad market, which tends to skew heavily towards investment grade. The credit stress tends to be in the kind of high yield market right now, concentrated in the energy, and energy credits are something in the vicinity of 11% of the high yield market. So certainly a risk, banks that have a significant amount of exposure lending in that area would be more at risk than companies that are, or banks that would be more broad, broad level of loan books. So it's a concern, but not as dramatic as it relates to some of the larger U.S. corporations, publicly traded.
You mentioned the importance of info tech. Where's the risk there now? Is it still on China's supply chains? What if Apple came out and said, we're not, 5G's delayed? Is that the danger for that?
Well, we break the tech sector, semiconductors, certainly there's a supply chain issue there, and there's and market demand kind of going back and forth. You look at the container shipments to the port of Long Beach, the port of Los Angeles, one of the major trade ports. The imports were down 20% in the last month, year over year. So you see that, they get that sense. That's semiconductors and the hardware as well. And the software has been a preferred area of focus for us. And there's more basically subscription-based revenues, a little more visible, less sensitive to the virus, would argue, make that argument. And so that would be an area of focus.
How effective do you think the Fed will be here at trying to ease the pain?
Well, the Fed has certainly been aggressive in terms of intermediate cut, and they're expected. My colleague Jan Hatzius is expecting further cuts.
Will it work? Will it help?
Well, it'll help
and markets?
in some respects. Will it help to? It makes equities that much more attractively valued if rates continue to fall. So I'd say from a valuation perspective, it's good from an equity perspective. Does it help the economy? To a modest degree.
Finally, are you using Italy at all as a template for mitigation? Big developed economy, ex-China, in terms of the virus impact on banks and society?
Well, that is, I'll leave that to little bit to the, health officials, epidemiologists. Right. I would say from a fundamental perspective, it's certainly resulting in a slowdown in overall activity. You get that from conversations with clients, executives in business, and what we see in terms of some of the data. But basically, it's lower earnings, and valuation, and basically the sentiment has to be continue to adjust.